A gain or loss on the net monetary position shall be included in profit and loss and separately disclosed. The restatement of financial statement in accordance with this standard requires the application of certain procedures as well as judgment. The consistent application of these procedures and judgment from period to period is more important than the precise accuracy of the resulting amount included in the related financial statement. Historical cost financial statement. The statement of financial position amounts not already expressed in terms of measuring unit current at the end of the reporting period are restated by applying a general price index. Monetary items are not restated because they are already expressed in terms of monetary unit current at the end of the period. Monetary items are money held and items to be received or paid in the period. Assets and liabilities linked by agreement to these changes in prices, such as index-linked bonds, loans, are adjusted in accordance with the agreement in order to ascertain that the amount outstanding at the end of the reporting period. These items are carried at this adjusted amount in the restated financial statement. All other assets and liabilities are non-monetary. Some non-monetary items are carried at amounts current at the end of the period, such as net realizable value and market value, so they are not restated. All other non-monetary assets and liabilities are restated. Most non-monetary items are carried at cost or cost less depreciation. Hence, they are expressed at amounts current at their date of acquisition. The restated cost or cost less depreciation of each item is determined by applying the historical cost and accumulated depreciation, the change in general price index from the date of acquisition to the end of the reporting period. An example, PPE, inventories, merchandise, goodwill, patents, trademarks, similar assets are restated from the dates of their purchase. Inventories of partly finished and finished goods are restated from these dates of which cost of purchase and conversion were incurred. Detailed records of the acquisition dates of items of PPE may not be available or capable of estimation. In this rare circumstances, it may be necessary in the first period application of this standard the use of an independent professional assessment of the value of the items on the basis of their restatement. A general price index may not be available for the period for which the restatement of PPE is required by the standard. In this circumstance, it may be necessary to use an estimated base or example on the movements of the exchange rate between the functional currency and relatively stable foreign currency. Some monetary items are carried at an amount current at dates other than that acquisition and that of statement of financial position. An example of PPE that has been revalued at some earlier date. In these cases, the carrying amount are restated from the date of revaluation. The restated amount of the non-monetary item is reduced in accordance with the appropriate IFRS when it exceeds its recoverable amount. For example, restated amounts of PPE, goodwill, patents, trademarks reduced to recoverable amount. Restated amounts of inventories are reduced to net realizable value. An investee that is accounted for under the equity method may report in the currency of hyperinflationary economy. The statement of financial positions, the statement of comprehensive income of such an investee are stated in accordance with this standard. in order to calculate the investor's share of its net asset and profit and loss. Where the restated financial statement of this investee are expressed in foreign currency, they are translated at closing rates. An impact of inflation is usually recognized in borrowing costs. It is not appropriate for both the restatement of capital expenditure financed by borrowings and to capitalize that part of the borrowing cost and that compensates for the inflation during the same period. This part of the borrowing cost is recognized as an expense in the period in which costs are incurred. An entity may acquire assets under an agreement that permits its to deferred payments without incurring an explicit income interest charge, where it is impracticable to impute the amount of interest. Such assets are restated from the payment's date and not date of purchase. At the beginning of the first period of the application of this standard, the components of owner's equity, except retained earnings and any revaluation surplus, are restated by applying a general price index from the dates the components were contributed otherwise arose. Any revaluation surplus that arose in previous periods is eliminated. Restated retained earnings are derived from all other amounts in the restated statement of financial position. At the end, the first period in subsequent periods, all components of owner's equity are restated by applying a general price index from the beginning of the period or the date of distribution if later. The movements of the period of owner's equity are disclosed in accordance with ECS 1, so a statement of comprehensive income. This is standard that all items in the statement comprehensive income are expressed in terms of measuring unit current at the end of the reporting period. Therefore, all amounts need to be restated by applying the change in the general price index from the dates when the items of income and expenses were initially recorded in the financial statement. Gains or loss on net monetary position. In a period of inflation, an entity holding an excess of monetary assets over monetary liabilities loses purchasing power. An entity with an excess of monetary liabilities over monetary assets gains purchasing power to the extent the assets and liabilities are not linked to price level. This gain or loss on the net monetary position may be derived as the difference resulting from restatement of non-monetary asset, owner's equity, and items in the statement of comprehensive income items and the adjustment of index linked asset and liability. The gain or loss may be estimated by applying the change in general price index to the weighted average for the period of the difference between monetary assets and monetary liabilities. The gain on the net monetary position is included in profit and loss. The adjustment to those assets and liabilities linked by agreement to change in the prices index made in accordance with this paragraph is offset against the gains or loss on net monetary position. Other income expense items such as interest income and expense, foreign exchange differences related to invested or borrowed funds are also associated with the net monetary position. Although such items are separately disclosed, it may be helpful if they are presented together with a gain or loss on net monetary position in the statement of comprehensive incomes. Items related at current costs are not restated because they are already expressed in terms of measuring unit current at the end of the reporting period. Other items in the statement of financial position are restated according to this paragraph. Statement of comprehensive income. The current cost statement of comprehensive income before restatement and general report costs current at the time at which the underlying transactions or events occur. The cost of sales, the depreciations are recorded at current cost at the time of consumption. Costs and other expenses are recorded at their money amounts when they are incurred. Therefore, all amounts need to be restated in the measuring unit current at the end of the reporting period by applying a general price index. The gain or loss on net monetary position is accounted for in accordance with this part. Taxes. The remitted restatement of financial statement in accordance with this standard may give rise to difference between the carrying amount of individual assets and liabilities in the statement of financial position and their tax basis. The difference are accounted in accordance with ICIAS 12 income tax statement of cash flow. This standard requires that all items in the statement of cash flows are expressed in terms of measuring unit current at the end of the reporting period. The corresponding figures for the previous reporting period, whether they are based on historical cost approach or current cost approach, are restated by applying a general price index so that the comparative financial statements are presented in terms of measuring unit current at the end of the period. Information that is disclosed in respect to of either period is also expressed in terms of measuring units current at the period. For the purpose of comparative amounts in different presentation currency, a parent that reports in the currency of hyperinflationary economy may have subsidiaries that also report in the currencies of hyperinflationary economies. The financial statement of any such subsidiary need to be restated by applying the price index of the country in which currency is reported before they are included in the consolidated financial statement issued by its parent. Where such a subsidiary is a foreign subsidiary, is restated financial statements are translated at closing rates. The financial statement of subsidiaries that do not report in the currency of hyperinflationary economies are dealt with in accordance with ICIAS 21. If financial statements with different ends of the reporting period are consolidated, all items, whether non-monetary or monetary, need to be restated in the measure unit current at the consolidated financial statement. Selection and use of general price index. The restatement of financial statement in accordance with this standard requires the use of general price index that reflects the changes in general purchasing power. It is preferably that all entities that report in the currency of the same company use the same price index. Economy ceasing to be hyperinflationary. When an economy ceases to be hyperinflationary, an entity discontinues the preparation and presentation of financial statement prepared in accordance with this standard. It shall treat the amounts expressed in the measuring unit current at the end of the previous reporting period as the basis for carrying amounts in its subsequent financial disclosure. The following disclosure shall be made. The fact that the financial statement and the reporting figures for previous periods have been restated for the changes in the general purchasing power of the functional currency. As a result, are stated in terms of the measuring unit current at the end of the reporting period. Whether the financial statements are based on historical or a current cost period. Identify and level of the price index at the end of the reporting period and the movement in the index during the current and previous report. Disclosure required by these standards are needed to make it clear the basis of dealing with the effects of inflation in the financial statement. They are also intended to provide information necessary to understand that basis and the resulting amount. Hyperinflationary inflation is when the prices of goods and services rise more than 50% per month. At that rate, a loaf of bread would cost one amount in the morning and a higher ones in the afternoon. The severity of cost increases distinguish it from the other types of inflation. The next was galloping inflation sends prices up to 10% or more. Costs. The causes of hyperinflation has two main causes: an increase in the money and supply and demand pull inflation. The former happens when a government begins printing money to pay for its spending, and it increases the money supply rise at a regular inflation. The other cause, demand pull inflation, occurs when a surge in demand of strict supply, sending prices high. This can happen due to increased consumer spending due to growing economy, a sudden rise in export, and more in government spending. The two often go in hand. Instead of tightening the money supply to stop inflation, the government might continue to print more money. With too much currency sloshing around, prices skyrocket. Once consumers realize what is happening, they expect continued inflation, but they buy more to avoid paying a higher price later. This excessive demand aggravates inflation. It's even worse if it is stockpiled goods and creates shortages. Understanding a hyperinflation, when prices soar over 50% in a month, the economy is experiencing hyperinflation. This is often caused by government that prints more money than its nation GDP can support. The hyperinflation tends to occur during the period of economic turmoil or depression. Demands pull inflation can also cause hyperinflation. Soaring prices cause people to hoard, creating a rapid rise in demand chasing for few goods. Hoarding many creates shortages, aggravating the rate of inflation. Countries that suffer horrendous inflation rates are Germany, Venezuela, Zimbabwe, and other United States during the Civil War. Venezuela is still trying to cope with hyperinflation in present day. Effect: to keep from paying more tomorrow, people begin hoarding. That stockpiling creates shortage. That it starts with durable goods such as automobiles or washing machines. If hyperinflation continues, people hoard perishable goods like bread and milk. These daily supplies become scarce and the economy falls apart. People lose their life savings as cash becomes worthless. For that reason, the elderly are the most vulnerable to hyperinflation. Soon, banks and lenders go bankrupt since their loans were lost value. They run out of cash and people stop making deposits. The hyperinflation sends the value of the currency plummeting in foreign exchange market. The nation importers go out of the business as the cost of foreign goods skyrockets. Unemployment rises as companies fold. The government tax revenue fall and it's become trouble providing basic services. The government prints money to pay its bill, worsening the hyperinflation. There are two winners in hyperinflation. The first beneficiary are those who took out loans and find that higher prices make their debt worthless by comparison until it is virtually wiped up. Exporter also winners because the falling value of the local currency makes export cheaper compared to foreign competition. Additionally, exporter receive hard foreign currency which increases the value of local goods. The most well-known example of hyperinflation was during the Weimar Republic of Germany in 1920. In World War I, the amount of German paper marks increased by a factor of 4. By the end of 1923, it had increased by billions of times. From the outbreak of the war until November 1923, the German issued 9.8 quintillion paper marks. In that period, the value of the mark fell from about 4 to the dollar to 1 trillion to a dollar. At first, the fiscal stimulus lowered the cost of export and increased economic growth. When the war ended, the Allies sold Germany rather 132 billion marks in the war reparation. Production collapsed, leading to a shortage of goods, especially food, because there was excess cash in circulation. And few goods, the price of the everyday items doubled every 3.7 days. Inflation rates was 20.9% per day. Farmers and others who produce goods did well, but most people either live in subject poverty and left the country. Venezuela is the most recent example of hyperinflation. Prices rose to 41% in 2013, and by 2018, inflation was at 65%. In 2017, the government increases the money supply by 14%, and it is promoting a new cryptocurrency, the petro, because the Bolivar lost almost all its value against US dollar, and it can afford the cost of printing new paper currency. In response, people began using eggs as currency. A carton of egg worth 250,000 bolivars compared with 6,740 bolivars in January 17. Unemployment rose to over 20%, similar with that of US during Great Depression. So, in 2019, Venezuela foreign debts were also at 100 billion. The annual inflation rate prices is 15%. And in Zimbabwe had an hyperinflation between 2004 to 2009. So these are the countries that, and the United States also, incurred also hyperinflation. So the Fed has inflation by 2% per year. That the core inflation rate, which leaves out volatile of oil prices and gas prices. They move up and down rapidly depending on commodities trading. The effect of price of food and drugs of transport and distances. For this reason, the CPI also removes food prices from the core inflation rate. So, how to survive in hyperinflation? Despite the reality of hyperinflation, many people are still worried about it. So, if we were to happen, what are we going to do? So, number one, be prepared by having your assets well diversified. You should balance your assets among U.S. stocks and bonds, international stocks and bonds, gold, and other hard assets as real estate. Keep your passport current. You'll need it. Hyperinflation in your company. Your country makes your standard of living untolerable. Ensure that you have a wide variety of skills and talents. Hyperinflation makes a bartering system necessary when money is useless. A broad range of practical skills give you an advantage of when trading. If you need a wheelbarrow to pull a cask to buy a loaf of bread, you should know how to bake the bread. So, PRS perspective, the foreign operation in inflationary economies. The accounting applied to the foreign operation changes fundamentally when economy in which appears is determined to be hyperinflationary. This, coupled with accounting differences within IFRS and US GAAP, means that identifying hyperinflationary economies is an essential step in the financial reporting process of multinational dual reporter. So, accounting for foreign operation is often complex. It is first required that companies establish and maintain process and control to ensure the consistency and the consistent application of accounting policies and the correct treatment of intercompany transactions. So identifying hyperinflationary economies. Both IFRS and US GAAP explicitly recognize the identifying hyperinflation requires judgment. But while the assessment methodologies are not aligned, in our experience, conclusions about the hyperinflationary status generally do not diverge. ECS29 lists 5 indicators of hyperinflation to be considered along with any other relevant factors when analyzing the economic environment of the country. One of these indicators is a cumulative inflation rate over 3 years corresponding or exceeding 100%. However, this is not determinative and should not be considered in isolation. So, the indicators are: the general population prefers to keep its wealth in non-monetary assets are in relatively stable foreign currency, and amounts of local currency held are invested immediately to maintain purchasing power. Number 2, the general population regards monetary amounts not in terms of local currency but in terms of relatively stable foreign currency. Prices may be quoted in that currency. Third, sales and purchases are credit that take place at prices that compensate for the expected loss of purchasing power during the credit period, even if the period is short. Interest rates, wages, and prices are linked to a price index. The cumulative inflation rate over these periods are approached in the exceed of 100%. So, we have now the approaches. The steps are: number 1, perform a quantitative analysis of the cumulative inflation rate. Any economy that has cumulative inflation rate for the 3 years preceding the beginning of the reporting period in excess of 100% is considered to be hyperinflationary. The step 2 is resorts the cumulative rate being less than 100%, judgment is applied in analysis of historical inflation rate, trends, and other pertinent economic factors. When dealing with countries in economic stress, step 1 can require judgment because there may be not be a single reliable general inflation index available for the full 3-year period. The IFTF side has developed a process to identify and monitor country inflation statistics. Our experience is that historical, US GAAP, and dual reporters are often use the ITF analysis as significant reference point of their documentation. However, this does not relieve management of its responsibility to perform its own robust assessment of potentially hyperinflation economies in both GAAP. Companies should also have appropriate controls in place to monitor such economies. As already mentioned, there are some differences in the IFRS and US GAAP approaches. Therefore, underlying the data on the economy should be consistently used in the both assessment. The reporter may need to demonstrate that its assessment and complies with both approaches. What to look for at year-end? The country that has generated much discussion recently, which is likely be the most significant for U.S. companies for foreign operation. In Argentina, we understand that most of, if not all, dual reporters reached the conclusion that would not require hyperinflationary accounting for both the U.S. GAAP and IF reporting for the first and second quarter of 2017. This was based on the assessment of the drivers behind the available inflation number, as well as the fact that other qualitative characteristics of the economic environment do not point conclusively to the existence of hyperinflation. However, this is a highly judgmental assessment. There is no indisputable consistent inflation index available, and the cumulative 3-year inflation rates that can be derived from the available data are sufficiently high that any change in the other qualitative characteristic of the economy in the third and fourth quarter could be enough to conclude that Argentina has become a hyperinflationary economy. Ukraine is another country that in 2017 who experienced the hyperinflationary. Accounting for foreign operation in hyperinflationary. Under both GAAP, once an economy is identified as hyperinflationary, the accounting required as a group level for foreign operation in that economy is substantially different from that applied previously. In addition, hyperinflationary accounting under US GAAP is fundamentally different from that under IFRS. As can be seen from the summary, the required methodologies for hyperinflationary accounting generate measurement differences between IF and US GAAP. Additionally, transition requirement IFRS and US GAAP result in a timing difference for the application of hyperinflationary accounting. So, example. So, IAS 29. So, this is now the end of our module 5, and we go now to module 6, the IFRS for small and medium-sized entities. You may have to do all the activities and module that is given and pass it within a given period. Always stay safe, and please review, because after the module 6 we will be having our final examination in week 9 for module 4, 5, and 6. Thank you.